Hey everybody, my name is Good evening, 16th of May 2017, your weekly video. In front of you is a period in history that should look pretty good to you if you've been following the videos week after week. Green line is the 50-day moving average. The purple line is a 100. The blue line is a 200. These are moving averages for the S&P 500 index. This was a very good time for the market, as the moving averages would suggest. Had some rolling over, some correction here, consolidation, whatever you want to call it. Regained its traction right in here. As you've learned, this says good things about probabilities going forward. Here's another period in history that looks very, very similar, maybe less volatile in here. Very good extended run, corrections in here, good setup here at the end of this period. What if I told you that during this first period, here it is again, we had a statistic looming that said individual investors put a record amount into stock mutual funds during these 2 years, nearly as much as the 20 years that encompassed the decades of the 70s and the 80s. How would you be feeling about prospects going forward, knowing that people had just been pouring, individual investors no less, had just been pouring into the market, versus the second period, similar looking setup, where merely 52% of US adults own stock. Only the second time ownership had been this low during the entire life of the Gallup survey. Last week's weekly message, I quoted from the very good book, Physics of Wall Street by John Wetherall. The end of that quote talks about what makes the balloon pop. In some sense, it's an external cause, tree branch, pin, etc. But those same influences, under most circumstances, do not affect the balloon. A balloon has to be inflated or even overinflated for an external cause to pop it or to take hold. Moreover, the particular external cause really doesn't much matter if you have a very inflated balloon. As you may recall, if you read that, I was talking about why certain things that have happened in recent history didn't really burst the market as so many people expected it would have. I suggested that had those same events occurred in late 2007, when the balloon we know in retrospect was ready to pop, that they probably would have gotten the blame, at least as being catalysts. And then there's always John Templeton, one of the greatest investors of the 20th century. He said this, I agree, it's been my observation over the last 32 years that bull markets are indeed born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. So again, you got this, people pouring in, and you got this, people staying away. Which scenario do you feel better about? Well, I think most of us would feel better about this scenario as being a situation where we could see money rush in. If indeed people are at record lows in terms of participation and the market is this high, generally it's the fact that other people are making money is what draws more people in. This suggests that there's much more fuel to push the market higher than perhaps this would suggest. Well, that first period happened to be the mid-90s, and that 2 years happened to be 92 and 93. And as I suspect you know, the rest of the decade was absolutely phenomenal for stock market investors. And this is right now. In fact, this was this morning when I ran this chart. Therefore, we are going to proceed as if this market has more room to run. That's what all the indicators are telling us, and we'll continue to proceed in that direction until the indicators tell us something different. I showed you a few weeks ago a comparison between the setups in 2017 versus 2013. We looked at 1 and 3 years going in. We looked at other breadth indicators and so forth, and it was startling, the similarities between 2013 and 2017. Here we are up to date this morning. You can see very similar looking price action in the 2 years. Here's how 2013 unfolded for the remainder of the year, a whopping 29% gain. Our clients did exceedingly good in 2013, as the market gain would suggest they should have. But I also explained how it came with a great deal of drawdowns. In fact, very soon, if this were 2013 again, we had a 7.5% decline. Not quite a correction. You got to have at least 10%, but a drawdown that would equate to about 1,500 Dow points today. So it will not surprise me in the least if that happens this year. In fact, it could happen at any time. In fact, in 2013, we had 13 drawdowns greater than 1% for a grand total of 38% roughly in total drawdowns. You had to live through this stuff. You had to have a strong stomach. I also in the past layered on the moving averages that said there was nothing in those indicators that said we should view this as anything other than volatility to ignore. Of course, we don't know how it's going to unfold, but I think it behooves me to help you understand that even in the best, most healthiest of market setups, we're going to have volatility, and it's good to expect that, because then when it happens, maybe we won't be as rattled as we otherwise would be, and hopefully it'll keep us from making those emotionally driven mistakes that tend to hurt results over the long term. So folks, thank you as always for watching and listening. Look for the weekly message in the next few days, and I'll talk to you again next week. Take care.